What is a bull market? A bull market is the condition of a financial market in which prices are rising or are expected to rise. The term bull market is most often used to refer to the stock market but can be applied to anything that is traded, such as bonds, real estate, currencies, and commodities. Because prices of securities rise and fall essentially continuously during trading, the term bull market is typically reserved for extended periods in which a large portion of security prices are rising. Bull markets tend to last for months or even years. A bull market is a period of time in financial markets when the price of an asset or security rises continuously. The commonly accepted definition of a bull market is when stock prices rise by 20% after two declines of 20% each. Traders employ a variety of strategies, such as increased buy and hold and retracement, to profit off bull markets. Understanding bull markets. Bull markets are characterized by optimism, investor confidence, and expectations that strong results should continue for an extended period of time. It is difficult to predict consistently when the trends in the market might change. Part of the difficulty is that psychological effects and speculation may sometimes play a large role in the markets. There is no specific and universal metric used to identify a bull market. Nonetheless, perhaps the most common definition of a bull market is a situation in which stock prices rise by 20% or more from recent lows. Since bull markets are difficult to predict, analysts can typically only recognize this phenomenon after it has happened. A notable bull market in recent history was the period between 2003 and 2007. During this time, the S&P 500 increased by a significant margin after a previous decline. As the 2008 financial crisis took effect, major declines occurred again after the bull market run. Bull versus bear markets. The opposite of a bull market is a bear market, which is characterized by falling prices and typically shrouded in pessimism. The commonly held belief about the origin of these terms suggests that the use of bull and bear to describe markets comes from the way the animals attack their opponents. A bull thrusts its horns up into the air, while a bear swipes its paws downward. These actions are metaphors for the movement of a market. If the trend is up, it's a bull market. If the trend is down, it's a bear market. How to take advantage of a bull market. Investors who want to benefit from a bull market should buy early in order to take advantage of rising prices and sell them when they've reached their peak. Although it is hard to determine when the bottom and peak will take place, most losses will be minimal and are usually temporary. Below, we'll explore several prominent strategies investors utilize during bull market periods. However, because it is difficult to assess the state of the market as it exists currently, these strategies involve at least some degree of risk as well. Why is it called a bull market when prices go up? The actual origin of the term bull is subject to debate. The terms bear, for down markets, and bull, for up markets, are thought by some to derive from the way in which each animal attacks its opponents. That is, a bull will thrust its horns up into the air, while a bear will swipe down. These actions were then related metaphorically to the movement of a market. If the trend was up, it was considered a bull market. If the trend was down, it was a bear market. Others point to Shakespeare's plays, which make reference to battles involving bulls and bears. In Macbeth, the ill-fated titular character says his enemies have tethered him to a stake, but bear-like, I must fight the course. In Much Ado About Nothing, the bull is a savage but noble beast. Several other explanations also exist. Are we in a bull market as of 2022? Generically, a bull market exists if the market has risen 20% or more above its near-term lows. Since the dramatic market sell-off during the 2008-09 financial crisis, the stock market has shown a resilient bull market, rising significantly, and reaching new all-time highs more than 10 years after that market crash. Despite some sharp pullbacks along the way, What makes stock prices rise in a bull market? Bull markets often exist side by side a strong, robust, and growing economy. Stock prices are informed by future expectations of profits and the ability of firms to generate cash flows. A strong production economy, high employment, and rising GDP all suggest profits will continue to grow, and this is reflected in rising stock prices. Low interest rates and low corporate tax rates also are positive for corporate profitability. Why do bull markets sometimes falter and become bear markets? When the economy hits a rough patch, for instance in the face of recession or spike in unemployment, it becomes difficult to sustain rising stock prices. Moreover, recessions are often accompanied by a negative turn in investor and consumer sentiment, where market psychology becomes more concerned with fear or reducing risk than greed or risk-taking. Thank you for listening. Like and subscribe.